Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And I'm just honored to bring back Mr. John Sterling, who has taken it upon himself to continually update and improve the 52-year spreadsheet. How you doing, buddy?
I'm doing awesome. I was looking forward to this one. It's been a while since we've been together.
Yeah. Well, the fact that you take the time to update the spreadsheet is amazing. The fact that you continually add material is just awesome. And so let's bring it up and talk about what's changed and improved this week. Let me share it. One sec. So, folks, if you don't know what we're referring to, there was a spreadsheet I created probably a year ago or so that John has taken upon himself to continually improve month after month. And there's a couple of things that are important about this. First and foremost, we list all the data sources. And the one thing that John added this week, a lot of people have asked about the affordability, how it's calculated, what are the rules. So you went out and found it. Tell us about it.
Yes, I went to the website for the National Association of Realtors and got their methodology right there. If you click on that link, you'll see it.
So I clicked on it. I don't know if it continually shares. Are you seeing this, or do I have to share it separately?
I don't see it.
So let me stop and then share again. All I did was click on the share, but here we go. One sec. Yeah, because when I click on links in Zoom, it doesn't bounce screen. So this is what I clicked on. This is the National Association of Realtors housing affordability methodology.
Right. And if you go down about 3/4 of the way, and you'll see the values come into play. The formula, you see that formula there?
I do.
Yeah, that's basically what I used.
Yeah, I like it. I'm just looking at the formula because I geek out on these things. Yeah. Okay. Yeah. Affordability is really important. It is what caused Olivia and I to sell in 2006. It is at record lows today. It is getting it. Let's be clear. It's getting worse. Interest rates are rising much faster than wages. Prices aren't declining. They're proving to be very sticky, at least declining that much. Hence, the housing crash in transactions is happening. So let me go back to the spreadsheet because we got more and more to share. So let me bring that back up. Again, back on our sources, we just put the data in here. We put all the colors and graphs and trends and ups and downs. But one thing you've updated for us is inventory. Yeah,
and you see the orange, it rolled over.
It certainly did. Again, if you go back and watch my channel, you will know that I called July 15th an important date. It's where National Association of Realtors actually reported June information. That caused a spike in supply, right? I said that FOMO from sellers would happen. That occurred in July. That occurred in August as expected. But what happened in September is it rolled over. We are seeing cancellation expired. And I believe we will see inventory fall into the end of the year. So again, I called it on my channel July 15th and it happened. I called it weeks before it. I called September 15 weeks before it and it happened again. So we will see where inventory goes. I expect these numbers to go down as we get into the end of the year.
Well, your prognostications are a lot better than mine.
I've been doing this a long time. Sometimes the dominoes appear clear and sometimes they're fuzzy. This one appears pretty clear because again, we've had record demand destruction. Everybody and their brother is talking about interest rates being 4 basis points higher, which is supposed to lead to a 40% crash, right? How many times have we heard if interest rates go up 1%, housing has to crash 10%. If housing goes up or interest rates go up 2%, housing has to crash 20%. Folks, that's an affordability calculation. That does not work. We have interest rates 400 basis points higher, and everybody is saying that real estate has to crash 40%. That's not how it works. We have a demand equation and a supply equation, and the supply equation is being distorted because the Fed broke housing. So it's pretty fun to look at.
Yes, it is. I can't wait to get the 2022 data in there because we're going to see some dramatic changes there.
Yeah, I actually did a conversation with Anna Kelly earlier in the week where we just manufactured the 2022 numbers as is, and they are ugly. Affordability is ugly. It's not quite 1981 ugly, but it's close. So let's go back to 81. 81, I think, is the worst year for affordability. Yeah, 81. It's just ugly. And again, 2022 is going to be ugly, right? Median price, I think we put in was 386. We put in a 7.08 interest rate. It's bad. It's really bad. And that's why calling a housing crash in transaction is easy for me. And frankly, don't get enough credit for calling it so early. But yeah, it's not going to get any better, John. We are in a housing depression. It's going to pull the economy into a recession, and 2023 is going to be one year we have to all slog through.
Well, I'm finding that in my buy box, which is not the national numbers, the properties are being snatched up still.
Yeah, it's really interesting. A buy box. So my buy box in Fresno, California kind of inflated when I said it would, July and August. Lots of wish pricing. Some of those were pulled off where sellers like, hey, if I can't get my price, I'm pulling it. A couple of transaction moves, but I've actually seen my inventory contract. There are less deals today in October than they were in August. So it's really wild.
I got 0 properties in there right now.
Dang, wow. That again. I wish people understood. Supply destruction is real. We're going through it right now.
My buy box, it's very specific, and
Sure,
there
of
used to
course.
be a lot of properties, but this is the lowest I've ever seen. None.
Yeah. It's hard to go below 0.
Yeah.
Yeah. So, John, thank you for doing this. You also did a 10-year stocks that we tweaked. Let me share
Yes.
that.
Look at the 10-year tab.
Yeah. Let me just share it again. Sorry. Yeah. So one thing we were trying to do is make a fair comparison with stocks and real estate. So we tweaked the math from last time. Right?
Yes. The green line.
Yeah. So we've added that in there. Right. Gross profit. I think that's fair to put in there. So, yep.
I do too. You could even double the stocks to 400,000. It wouldn't match the growth rate.
Yeah, again, real estate being a leveraged
estate.
business, you're getting all the appreciation, even though you only have 20% equity, at least in this case, right? That's your down payment. It's just, it's tough to compare. It's almost unfair, but some people want to buy stocks, dollar cost average. That's awesome. You do you find your thing as long as you're willing. For me, John, it really boils down to doing the work, like your hat says. If you're going to be a stock person, be a stock person. Go all in, learn, figure out companies, figure out, whatever it is, right? You do you. For me, I tried stocks. It didn't work out well because I got lazy, stopped doing the work. For me, real estate is just easier, right? A buy box, daily discipline. It's just my jam.
Well, it can read your book now and look at that chart and say, well, we like him now.
Oh, we like him now. Exactly. Well, John, I appreciate you doing this. I know it's a lot of work. I appreciate you listing sources. It's really important for me to keep putting sources because it's not our data. It's sourced from somewhere else. You can go back and look at the 52-year spreadsheet. We give it away in our free course. It's on Teachable. It's in the link below. Go nuts. We've got 3 or 4 versions of it there now. You can see how it's evolved over time. So, John, thank you so much.
You're very welcome, sir.